Well, is 2012 a year for the bears? Let's bring in Ryan Ben from the Prudent Bear Fund. He certainly hopes so. Given Standard & Poor's downgrade in Europe, how does that change your outlook, your strategy for 2012, or does it not? Had you priced this and expected this to come?
That confirms our thesis. It confirms the thesis of Europe is going to drive everything. You watch the euro. Euro weakness tick for tick drives everything. Euro weakness drives the S&P. So all that says is, okay, now we've got a real big flashlight on this euro, and the only thing it does is there's going to be more confirmation of our thesis. And as our thesis plays out, we're going to build those positions that have European exposure on the short side.
What are you looking at? Can you name specific stocks that you'd be short on, or can you look at it by a sector basis?
Yeah, I mean, there are a lot. We can't talk about specific stocks, but a lot of industrial stocks have a lot of European exposure. There are a lot of the consumer staple stocks have a lot of European exposure. So these are areas where, especially from a beta perspective, the shorts can be very attractive. So
even big manufacturers that have been doing well here in the United States because of their exports to Europe could be in jeopardy here.
Exactly.
It's interesting. You guys have also written about your concern about CDS's protection written on the euro, on credit default swaps and what might happen there. Is that playing into your moves right now whatsoever?
Well, it's very difficult to tell because the CDS market is, as you know, very opaque. But I mean, the one thing we would have concern about is we think that a lot of protection has been written on the euro. So if we see euro weakness, when everyone is on the one side of a hedge,
right,
you can get, as I said before, dramatic weakness. And if you get euro weakness, then you have problems with correlations with not only the sovereign debt, but also the banks. It's all one trade. So if you get weakness in the euro, you never want to trigger these credit default swaps, and if you do trigger them, that's the scenario that no one has an answer for.
Well, let's talk about the opposite side of it and how, especially the U.S. equities, et cetera, could capitalize on this weakness in Europe, places where you wouldn't want to be short in 2012.
Well, usually we're biased against shorting oil stocks and hard assets. Historically, we've been very bullish on gold, and these are areas where we would not want to short. Other places we wouldn't want to short if they derive all their revenues in the United States. We wouldn't be very interested in shorting that because part of the bearish euro thesis is a strong dollar thesis, and these are areas that we would want to avoid.